Alright, welcome to another video. This week we are going to be looking at US cyclicals, cycle high. This topic comes from the weekly macro themes report. This is from a few weeks ago. This is the part of the premium service offering that we have, mostly used by hedge fund managers, pension companies, etc. But look, just as a quick insight into how this report is structured, what we do is we have a bit of a write-up here, a bit of a narrative that ties it all together, the bottom line, because, my view is that your time is important and that you want to save time, that you want to be reading less and looking more at the charts and the data where the most meaningful stuff is. And, so we have the charts here and a bit of text, a bit of commentary around it. So look, let's get straight into the analysis here. And I think that this is really quite an important topic indeed, because, it is about one kind of aspect of the market. So cyclicals, stocks or cyclical sectors versus the defensives. And, some people will make punts, particularly in these two sectors. They'll take a view on defensives and go at it, or, cyclicals, they might even do a peers trade, long, short. But it has wider market implications as well, so as we'll soon get into. So in terms of the bottom line, we've got US cyclicals, while mapping to the improvement in the PMI, looks stretched on a relative performance and valuation basis. Caution is advised. So that seems kind of ominous, and there's good reason. Let's get into it. So chart number 1. This one I think really is a key one that everyone should be aware of. The red line here is showing cyclical sectors versus defensive sectors, and that's relative performance. So if you see that line going up, that means that cyclicals are doing better than defensives. And if you see it going down, it means that the defensives are winning out. And you can see there that, well, over time it trends up. I've put a trend line there to give a sense for how it's moving against trend, because often talk about there's really two kind of signals in the market when it comes to things like this. It's either deviating from its long-term average, which doesn't really apply for this one because it's a trending rather than mean reverting series. It's actually reversion from trend or deviation from trend is the key for this one. And as you can see there, we had surges in performance, relative performance, into the height of the dot-com boom and the final stages of the 2007 market top there, and also in the various peaks and troughs of the post-crisis environment. And now we're getting this kind of pattern emerging again. And it's important too to look at this and realize that this renewed bull market that we've had over the last 12 to 18 months has actually really been driven by cyclicals relative performance. And so it's if it mattered for that bull market, then it matters for the outlook, because anything that's going to impact on that is going to be key. The reason why we look at cyclicals versus defensives from an economic or cycles point of view is that obviously the cyclical sectors do better when the economy is doing better, and the defensives they just tend to plod along, sometimes even do better when things are not going so well. And so obviously if the economy is booming, then the cyclical sectors benefit, and you can see that here in the chart on the right. You can see that the black line is the ISM manufacturing PMI, and overlaid we've got the cyclicals versus defensive relative performance. You can see there that that surge in cyclicals relative performance actually mapped pretty well to what's been happening in the PMI. One of those problems is that, when you think about the various signals, various factors that you look at, when it comes to cyclical factors like these, they go in cycles. So when things get really good, and when they get really good, they're only going to be really good for so long, and then they roll over. and when things get really bad, they're only going to be really bad for so long, and then they turn up. It's a cycle. That's why we call it a cyclical indicator. So when you look at these ones and you see them, really looking like they're at cycle highs, it makes you think that this theme, which has played out over the last 12 to 18 months, is running on borrowed time. And then you look on the next page. So valuations are, sometimes a little bit of a controversial indicator because, something can get overvalued and get more overvalued and get extremely overvalued before, valuation, quote unquote, matters. You can see here that, that kind of thing has really played out over time. So if you look at the chart on the right first, going into the .com bubble, you can see there that the cyclical sectors went to extreme valuations. The defensives actually were dragged along as well. There was partly the telcos, partly the healthcare aspect. You can see there into the final stages of the 2007 market there that you had this parabolic run up in the price to book ratio for those cyclical sectors, and we're seeing that now in a big way. Like, this is really an astounding run up in valuations there, and certainly on relative value front as well, which is the red line, which just compares the black line, the cyclicals, versus the defensives in the blue line. And then quickly also looking at the one on the left, that is basically the same view, but it's also presenting to the relative performance ratio, which is the black line, and the blue line is the composite valuation indicator. So it's looking at price to book, EV, EBITDA, dividend yield, price to earnings, a few different indicators, as many as I can get. My view is that when it comes to valuation indicators, the more that you can combine into a single signal, the more powerful the messages that you get from that. So you can see there that it's not as extreme as it has been in certain times in the past, but it's definitely at the top end of the range. And when it gets to these kind of levels, that's often when you get a sort of a peak or a topping out in relative performance between the two. So when you look at valuations being fairly stretched for cyclical sectors, whether it's absolute terms in the black line over here on the right hand side chart, or in relative terms, and then you also look at the fact that the ISM, the cyclicals versus defensive ratio itself, tends to get to a point where it's so good that it's bad, because usually it just rolls over after that. And when you think about the overall market and how it's the cyclical relative performance that's been driving the bulk of the new bull market, you think that this is really a key theme. And should that start to roll over, that's going to be key for setting the direction of the S&P 500 over in the coming months. And I hate to jump at shadows or be alarmist, but when I see these set of charts, I certainly think that the caution levels are higher or elevated, and it can keep on going. The cycle can stay good, but there's only a matter of time before it rolls over. And from a practical standpoint, this comes down to whether you look to improve your risk management, or try to preempt it, or wait until you've seen confirmation that things are indeed rolling over. I tend to fall into the latter camp, but I also suggest would say that thinking about ways to manage risk or non-correlated trades, cash is king, can be really effective, and it's down to every individual and every organization as to how they run their asset allocation. But here the charts are, and If you've got any comments or questions, you wanted to add your 2 cents to the mix, please do go ahead and do that in the comment section below. And if you like this video, please do subscribe to the channel. We'll be putting out more of these in the future, so stay tuned.